All right, all right, all right. Hello, hello, hello. How's everyone doing? Check, check, check. Hello, team. Hello, hello, hello. Good morning, good afternoon, good evening. Let me double check something really quick. Should be all right. Should be all right, I believe. Okay, perfect. Okay, which sector stocks will boom? No idea. No idea. No idea. Well, we can take a look at some stocks actually. It's quite interesting. I've been doing some work on stocks as well. We can take a look. I've been doing some module work to prepare a module. Hello. Hello from the UK. Welcome, welcome, Lewis. How are you doing? Hello, hello, hello. I was at the barber for sure. Yeah, for sure. Exactly. Netflix, yeah, Netflix has been in a well, and arguably sort of a fight with Twitter, with X. Quite interesting to take a look at as well. Thank you very much. Thank you, Abdul. Thank you, thank you. Hello, Amy. Hello, Marcus. Hello, Husan. I hope I pronounced it correctly. Sorry if I didn't. Hello, Johnny from Brazil. Love to see it. Hello, Brian. You trained the free money contest Patrick Whelan today. Starts at 6 p.m. Ooh, I'm not actually aware of that. No, probably won't. No. I'm not sure what it is actually. I wasn't aware anything was going on. From the UK, love to see it, Emmy. Love to see it. Hello, Danish. Hello, hello, hello. How's everyone doing? First of all, before we dive into anything, before we dive into a forecast, anything like that, I want to pick out a topic. A topic that you suggest, that you want me to go over, you want me to explain, you want me to dive deeper into, it doesn't make sense to you or anything like that. Mention it. Now's your time. Mention it. We can go over questions as well afterwards. And we'll go over the forecast as well. But after the forecast, I want to dive into some topics. So what doesn't make sense to you? Area of opportunity, I see right here. Okay. Might dive into area of opportunity. It's important. Hello, Jordi. Hoe gaat het? What is it? What is it? Time plus volatility. Okay. Daily bias, retracements, liquidity sweep. Okay. Let's see. Area of opportunity, I see again right there as well. Two candle rejection. Disrespect of two candle rejection. Area of opportunity. Okay. Okay. Let me see. News. It's also a good one, Michael. Let's see. Stocks. Okay. Two candle rejection. Okay, perfect. Daily bias and liquidity sweep. Okay, I have something in mind. I see area of opportunity quite a lot. I see two candle rejection. I see some stocks as well. Disrespect of two candle rejection. Stocks forecast I see again right there. Okay, perfect. We can combine that quite nicely. Area of opportunity combines quite nicely with two candle rejection. Combines quite nicely with daily bias. Combines quite nicely with stocks as well. Okay, let's see. Let me write that down quickly just to make sure that I don't forget. Let me see. Live. Okay. That was area of opportunity. That was two candle rejection. A little bit of daily bias. And I saw some stocks right there. Okay, perfect. We can dive into that. And of course, we can dive into some more as well. We also have the question link in the description. First link in the description. If you do have any questions, we'll see. I'm planning for this to be quite a long live stream as well. Of course, if my brain absolutely dies down after the first hour, we'll cut it short probably. But other than that, I have the time, I have the energy, so we can dive into it. Psychology, okay, we can dive into psychology as well. Actually, I like the topic. Let's see. So I hope you don't have anything planned for today, for the rest of your day, because we have a long session ahead. We have a long live stream ahead right here. All right, let's dive into it. let's get started. Let's get the first thing out of the way, and that is the forecast. Let me see if everything is set up properly right here, just to double check. If you do have any questions, also, of course, I sometimes read the chat as well during the forecast. So if something doesn't make sense, that's very important. If something doesn't make sense, let me know. Let me know. That's important because then I can clear it up as well in real time right here. Okay, so I made the Trump video. And in the Trump data, what we see, for example, is that it doesn't really matter what the economic calendar looks like at this moment in time or how it shapes up to be, because the volatility is very random, arguably. And that's something important to understand. Now, that's not necessarily a bad thing. Could be a little bit scary, but it's not a bad thing at all, because just more volatility means arguably just a little bit more opportunities as well. What is important to understand is that the government is still, the US government is still in shutdown. So for example, we see Friday right here, we potentially have NFP, but it's still tentative. It's still not certain if we will get it. Again, that's something for us to worry about at the end of the week. We have FOMC meeting minutes right there on Wednesday, 2 p.m. This is not FOMC statement, right? So this is not the big three news event. That's important to understand because the other one is FOMC statement. That is the large volatility that we need to watch out for. Other than that, the week looks all right. Looks all right right here heading into this week. If we can get some unemployment claims right there as well, would be lovely. Overall, lovely economic calendar right here. Perfect. Let's dive into trading view. All right, let's dive first into the dollar. So the first thing I want to discuss, and what I think is an important topic to understand. Now, this is arguably a little bit similar on the indices, which we're going to dive into in just a second as well. But first, I need you to understand this. This was the thumbnail of this live stream. And if we take a look at the scenario, then what is happening currently on the dollar? We see that we are moving lower, disrespecting, for example, this bullish fair value gap right there. And afterwards, what we see is we trade back into this fair value area. Also, of course, we have the overlapping fair value gap right there. We can just combine them, take them as one. The fair value area right there is the most important. Okay. Now, what we see right here is that we have this, arguably we had this rejection low. You could argue that might have moved to this low right there as well. We'll just take this low for the sake of it right there. And we also have this bearish daily fair value gap. What is important to understand at this moment in time is I like to think of the market as momentum. So I see, for example, the question right here, what really is a trend? What really is a trend? The way we can define a trend is by, if we are bearish, then what makes this trend so bearish? Well, when we are bearish, we are disrespecting discount arrays. So the way we are disrespecting discount arrays is, for example, a fair value area, fair value gap, that's a discount array, right? The way we disrespect is to get a rejection, the rejection low. If we start running the rejection low right there, then we are disrespecting it. So if we are disrespecting discount arrays, respecting premium arrays, it's a bearish trend. Vice versa, inverse that for a bullish trend. If we are disrespecting premium arrays and we are respecting discount arrays, that's a bullish trend. Now, you'll see the problem right here because we are respecting a discount array and we are respecting a premium array at the same moment in time. So I like to think of the market as momentum. If the market wants to make anything happen, so it wants to continue higher, it wants to continue lower, what should happen? Besides disrespecting discount arrays, etc., etc., one side of the market should be stronger, which means one side of the market, the other side of the market should be weaker. So either one side is weaker or stronger, and that makes the market move, if that makes sense. And that then in turn makes it so we are disrespecting discount arrays, etc., etc., etc. So see it like that tug of rope, right? Let me see if I can find a good example of this, just so everyone understands. Let's see. Tug of war, I believe, is the name. Let me see. This right here. This game right here. This, I think everyone is aware of what this game is, right? Right here. Okay. Let's say here on the left side, you have the bearish side. Here on the right side, let me move my camera. Here on the left side, you have the bearish side, the bearish hands. Here on the right side, you have the bullish hands. If they are both equally as strong, no one is going to win this game. It's going to stay in the middle, right? It's important to understand. So in order for this, the middle part of the rope to move right there, either towards that side or the other side, one side needs to be weaker, the other side needs to be stronger. That's super important to understand. And for example, if we go back to the chart right here, when we see that we are respecting a discount rate and respecting a premium rate at the same moment in time right there, imagine the rope right here in the middle is not moving anywhere. So what happens, you have two sides that are equally as strong. Touwtje trek, exactly, in Dutch. Yeah, so right here, we're not moving anywhere. So this becomes a consolidation. So that is at its core what a consolidation is right there. When we're stuck, when one side is not weaker, the other side is not stronger. That's super important to understand. So how can you trade these consolidations? It becomes super easy, super simple. Because in order for one side to be stronger or for one side to be weaker, what should happen? What did we just mention? What is a trend? Bullish trend is if we disrespect a premium rate. A bearish trend is if we disrespect a discount rate right there. So if we disrespect this discount rate, that fair value area, by running this 2-candle rejection low right there, then we can argue we are bearish again and we can start looking at these targets, at these lower targets right here. If we start to continue higher and we start running this rejection high, disrespecting this premium rate, and that means this right now becomes a target right there. So this, the way I like to call it, it just becomes a game of parameters. That's all it is. It's just a simple game of parameters. That's it. So what does that mean? Parameters. I like to think of parameters as boundaries as well. When we cross a certain line, for example, something happens. So if X gets met, that condition, then Y happens, if that makes sense. Okay, so for example, if we start running this rejection high right there, we are disrespecting the premium rate, the fair value gap. That's the only thing at that moment in time that's preventing us from continuing lower. So think of it like this. How many times when we continue lower right here, do we continue lower from a certain premium array? Fair value gap right there. You could argue when we have this rejection, it's also because of this swing high that we have towards the left right there. When we continue lower, we have swing highs right there, fair value gaps that we continue lower from right there. Okay, when we continue higher, how often is it because of a discount array? We continue higher from this swing low right there. We continue higher from this fair value gap right there, and that's where we get the rejection from. Okay, when we continue higher right here, it's also because of this swing low. You get the point, right? When we continue higher, we usually continue higher from a discount array. When we continue lower, we usually continue lower from a premium array. So a bearish variance. So right here, if we are not going to continue lower from this fair value gap like this, then what is likely going to happen? That we can continue lower from this next high right there. So this creates, and the topic we're going to dive into in just a second, what does that create? That creates an area of opportunity. Because if we're not going to continue lower from that fair value gap, the moment we run that rejection high, it's likely that we're going to run lower or continue lower from that swing high. And again, that doesn't mean we need to continue lower, but that just proves my point of this becomes an area of opportunity right there. The same way, if we start running this low right here, and we don't continue higher from this fair value area right there, then we can potentially continue higher from this low right there. And if it's not that low, then it could potentially be this next low. And every single time we then disrespect a certain PD rate, that becomes an area of opportunity. So right here, what is important to understand? This middle area, dangerous, scary, don't get involved, ideally right there. Again, unless you really love the type of price action where we're continuously moving up and down very fast right there without a very clear trends, perfect, go ahead. Other than that, generally speaking, for most people here, you want to wait until we either run this rejection low to then target that low. If we run this low, we want to target that low right there. Or the opposite side, if we target that high right there and we start running it, then we can target that high. We start running that high right there, we can target the next high. So we can target those highs, we can target those highs. And that continues like that. So when you understand this, it just becomes a matter of show me what's going to happen, market, and I'm ready. I'm ready for whatever the market is going to show me, and I'm ready to act on whatever the market right there wants to do. And I don't have a merit bias right here. Oh, this needs to continue higher because this happened or anything like that. No, you're just working with parameters. And this is where you get into a really, arguably, professional state. Because when you just work with parameters, you're very neutral. You don't have a preference right here. Well, of course, you could argue the area of opportunity right there is bigger, so I might prefer that. But other than that, if this continues lower, I'm just perfectly fine with that as it continues higher right there. I don't care. So this right here is the parameters game on the dollar at this moment in time. And that is crucial to understand. And this is also why and how you avoid these consolidations right there, which is also very important to understand. So let me give you one more example. For example, right here, When we talked about this daily fair value gap right there. And if we go into the lower time frame, the 4-hour time frame, you'll see this very clearly. We have this 4-hour fair value gap that we could continue lower from, and we have the daily fair value gap right there that we can continue higher from. So at this moment in time, what happens? What happens right here is that we are stuck in a consolidation right here. That we are stuck. The answer is just to avoid consolidations, right? Not necessarily. The answer is a little bit more in depth. Maybe I'm a little bit too obsessed with that, but when I say what is the best way to trade consolidations, the question and the answer is that then just to avoid consolidations, arguably yes, but that's very simply said, because you don't know how to avoid consolidations if you don't know why consolidations happen, and you don't know how to avoid consolidations if we are in a current consolidation and you don't know when we are getting out of it, if that makes sense. So understanding that leads you to then avoid consolidations. Gustavo, yeah, correct, exactly. Exactly. Let's see what we have right here. Yeah, it's somewhat true, Nizar. Yeah, you're not wrong. Okay, if we move on, let's first see how that then affects, for example, the Forex majors. If you trade Forex, it's so crucial to understand that all of these pairs are not the same thing. So for example, if you trade the dollar right there and you really focus on the dollar, then what is important, if the dollar does continue higher right there, then Australian dollar, US dollar, EU, GU, etc. should in theory continue lower. Now, of course, they're not going to all move lower at the same speed, if that makes sense. So some of these are weaker because they're not the same currency. So for example, if we take a look at a New Zealand dollar, US dollar, this is arguably weaker based on the previous price action that we had right there. I saw this question earlier, actually. I want to dive into it a little bit because it ties in quite nicely. Do you use an indicator for strength? To see the strength in the market, do you use an indicator? No, because the fair value gaps already tell you that. You don't need an indicator. The fair value gaps are the indicator, if that makes sense. A larger bearish fair value gap right there means that we are more bearish than a small bearish fair value gap right there on EU, for example. So that is why a New Zealand dollar, US dollar moved a lot lower in comparison to an EU right there. So the strength right here, the price action literally tells you that. It tells you, for example, if you put me next to Usain Bolt and you ask for a third party to verify the strength and the speed in the difference between me and Usain Bolt in his prime, do you need an indicator to identify that? No, just use your eyes. Just use your eyes. I'm going to be faster, probably. No. Of course not. I'm going to be slow. He's going to outsprint me all the way. So what is important to understand, just use your eyes at that moment in time. EU has been moving lower less than a New Zealand dollar, US dollar. The way you can see that is fair value gaps right there. How large is this fair value gap compared to an EU, etc.? That's very important to understand. So right here, for example, if we do start to continue lower on the dollar, an EU, the moment we start running these highs is going to be very interesting right there to potentially continue higher. If we do meet that parameter, of course. If we do continue lower, arguably have an area of opportunity right there to continue lower as well. Again, this middle sector, that consolidation, that's just not that interesting to me. If we focus on, for example, a GU, a little bit weaker. So for example, for an EU right here, for me, if the dollar continues lower and we do reach this area of opportunity right there, EU for me is going to be very interesting right there because it's very strong at this moment in time. So euro in comparison to the US dollar is quite strong at this moment in time. So that's going to be quite interesting. A New Zealand dollar, US dollar for shorts, also quite interesting right there. But that really depends. That's what I need to understand first. Is the dollar right here, which area of opportunity is going to be met? Is it this one? Is it this one right there? And then based on that, you already have in your mind, okay, if it's this one, I'm going to look at buys on EU. If it's this one right here, I'm going to look at sells on New Zealand dollar, US dollar, based on strength and weakness. All right. US dollar, Canadian dollar, also one of those. If the dollar does start to continue higher, if this area of opportunity gets met right there, the top one, the US dollar, Canadian dollar should ideally, of course, move higher as well. US dollar, Canadian dollar is going to be very interesting. If we continue lower right here, this area of opportunity gets met right there, US dollar, JPY is going to be very interesting. Why? Because US dollar, JPY, if you compare it to a US dollar, Canadian dollar, it's a lot weaker right there. So this is going to be interesting to buy if the dollar moves higher. This is going to be interesting to sell if the dollar moves lower right there. All right. Gold. Let's first go over gold. Then we'll dive into the indices as well. I saw Nazir, I believe. Nizar, sorry. I saw Nizar mention it right here as well. Argo is neutral unless it comes to the indices. I would also argue gold right there. You're not wrong. So when we dive into this price action, and I rant about it quite a lot, but I think it's just very important to understand, again, when you haven't really seen the light of profitability, so you haven't really gotten a taste for profitability, you don't really know where it is, if that makes sense. You're just messing around a little bit at this moment in time. Then what is important to understand that I'm just trying to steer you in the most efficient direction to reach profitability in the most efficient way, ideally. So what that means is, for example, if you make it yourself a little bit easier, then it's more likely that you're going to see some light of profitability sooner, if that makes sense. So the reason why I mentioned that is, for example, if you take a look at gold, then what has been happening on gold? We've just been moving higher. So when you try to short, for example, you try to sell these instruments right there, trying to call a top, you're going to make it yourself so much more difficult, if that makes sense. Of course, more difficult doesn't necessarily mean that it's worse, but I would argue if you just focus on the highest probability play consistently, which on gold at this moment in time is simply buying, evidently, like we see right there, you're going to have a much better time, if that makes sense. So right here, what I'm going to do is, again, I'm going to look to buy. Now, the thing that I'm going to do, which is important to understand, I'm not looking to buy by forcing a retracement. You'll notice as well, when I talk about the dollar, EU, etc., it's very similar as well. I'm not saying we need to retrace back into this fair value gap to then continue higher, etc., No. What is important right here is there something that is preventing us from continuing higher? Because if there's nothing preventing us from continuing higher, then we have all the reason to keep continuing higher, right? That makes a whole lot of sense. So what is the thing that is preventing us from continuing higher? For example, right here, we have the fair value area right there. And also, of course, the overlapping fair value gap that we have right there. Then we have this rejection high that we start running. Then when we start running this rejection high right there, nothing preventing us from continuing higher. So the path towards an all-time high is quite clear. Now, does that mean as well that it needs to play out 100% of the time? Absolutely not. But you're going to be on the high probability side a lot of times if you focus on this. It happens over and over and over. So right here, this is the moment this opens up is already very interesting to continue higher right there. Now, for myself, I'm going to see once we open up later today right there, if it's worth it to take a trade. And what do I mean with if it's worth it? For example, if we open up with a large lag right there, I might enter right here. And then my stop loss might go below the recent ortho lag. So right here, if I then target a 1 to 2 R, the 1 to 2 R is going to be way beyond as well the all-time high. For a Monday right there, I'm not sure if I'm a big fan of that overall at this moment in time. So for example, if the lag is a little bit lower, we start running these highs right there, and I can already get involved right there. Now that's going to be quite interesting for me on gold right there. And we have an easier target to work with as well. So very similar. This has been a trend, I believe, over the past 4 weeks, I believe, if I'm counting correctly, that we have, as soon as Sunday opens, this right here was as well, same case. Let me see, this right here was the same case as well. And I believe, was it here as well? No, not necessarily. Not necessarily. Last few highs, you could argue yes, no. I'll keep it in the middle. So right here, and then also, what was it? Right here and right here again. It's going to be interesting the moment we open up right there. At least for me, for my trading plan, to then continue higher. Again, once we reach all-time high, what is the plan of action? All-time high protocol, very straightforward. So right here, if we get a larger rejection again, overtake the rejection to continue higher again, like we've been doing over and over and over. Quite straightforward, quite simple in my eyes. So for example, silver right here to continue higher could also be very interesting. Next targets right there. But ideally, I would like to wait until we do have somewhat of a rejection right there to then overtake it and continue higher again. All right. Moving on to the indices right here. For the indices, that is a very similar story. So again, can we continue lower on the indices? Yeah, of course we could. We definitely could. But what we've been seeing is that we've simply been continuing higher. Over week in, week out, we've just been continuing higher. So could we eventually see a retracement? Yes, definitely. And once the retracement happens, we'll see it as well. But what I think is important to understand at this moment in time is that I would not try to call this top right here, and that we might continue lower, because trying to call a top, you might call this a top, you might call this a top right there, you might call this a top, you might call this a top right there. You're going to be wrong a lot of times. So you're going to be right more of the time if you just look to buy again. So right here, if we go into the 1 hour time frame, okay, at this moment of time, this 1 hour value gap right there, if we start to overtake it, create a rejection high right there, and then start running it again towards the next all-time high, that could be very interesting, in my opinion. If we do continue lower right here, and let's say this turns into a 4 hour value gap, then it's going to be off the 4 hour value gap right there. So just moving along with the time frames. If, for example, it might turn into a daily fair value gap right there, I'm going to use the daily time frame instead to continue higher again, if that makes sense. And that essentially is the same thing on, for example, NASDAQ. So what you'll notice on NASDAQ is that we do have a daily fair value gap that we could potentially continue higher from. That's all fun and games. But for me, what is more important right here is that we overtake, for example, the 4 hour fair value gap. The fair value gap that we have going against us right there. Because if we overtake that, then we have a clear path to continue higher. We can continue higher from the daily fair value gap right there, yes. But the moment we reach the 4 hour value gap, we might still create this consolidation to then continue higher, if that makes sense. So that is quite important to understand. So that's quite straightforward. On the indices right there, I'm going to keep an eye a lot on the indices right here and also on gold and silver. Going to be very interesting to see what we want to do. Okay, Bitcoin. Oh, wow. It's reached an all-time high actually. Very nice. Very nice, very nice. So what was important to understand on Bitcoin right here is that we had this weekly fair value gap right there. We had this swing high right there. We need to run that swing high, run the rejection high from the fair value gap, disrespecting the fair value gap, nothing preventing us from continuing higher anymore. Clear path towards the all-time high right there. So what is important? We had a question. Was it Wednesday? I'm not sure when it was, but we had a question. Do you wait for the daily fair value gap? Do you already enter on the 4 hour value gap? Do you enter on the 1 hour value gap? What do you do? How do you capitalize on this? At first, I would wait always for the daily fair value gap right there, especially when we're in a scenario like this, where the third candle right here is still forming. Now, if the third candle closes something like this right here, where we can now assume this might become a breakaway gap right there. So we're first going to reach these targets right there. Only then I'll dive into, for example, the 4 hour time frame to find a fair value gap right there to then potentially continue higher. If that turns into a breakaway gap, okay, well, it doesn't, perfect example, but let's say that did turn into a breakaway gap, then I will go into the 1 hour time frame to then find a fair value gap to continue higher from, if that makes sense. So that's the way I would go about it. All right, so if we are at an all-time high at this moment in time, what is important to understand is that it's again all-time high protocol. So if we can potentially create a larger rejection right there, can we overtake it to then continue higher again? Would be lovely right there. I hope that makes sense, by the way, all-time high protocol, because it's quite straightforward. Once you somewhat get a hang of it, we'll dive into it as well, because the area of opportunity is essentially the same topic, if that makes sense. So we'll dive into it. Okay, crude oil, to me, not that interesting, because we're just seeing this larger consolidation. So I'm not a big fan of this. Personally, I would rather avoid it. I would rather focus on something like the indices, the metals. I think it's just a little bit more interesting. So I don't really have an opinion on crude oil, in all honesty. It's not that interesting to me. Crosses right here, also very similar to me. Yes, Euro JPY, there could be some opportunities right there if we overtake these fair value gaps. But other than that, for me, again, there's enough opportunities right here, focusing just on this list. So that for me is already all right there. All right, then I want to continue this story with the topics that we had. And the topics that we had were area of opportunity, two-candle rejection, daily bias, stocks, and also a little bit of psychology. I'm not sure where I'm going to fit in psychology just yet, but I think this story, what we just mentioned, adds on very nicely to stocks, and we can move on to area of opportunity, which adds on very nicely to two-candle rejection, etc., etc. So when we talk about stocks, and I've been thinking about stocks quite a lot, I really like stocks. So the way I got into trading was also because of stocks. So what I think is very important to understand is there's essentially 3 cycles that you can use to capitalize on any stock, essentially. The 3 cycles. So the first cycle is you have a stock that is private. For example, I think everyone is aware of what ChatGPT is. It's ChatGPT is an AI created by OpenAI. That's the company behind it. And OpenAI is a private company. It's not publicly traded. So if you do have money and you are an investor in OpenAI, you can privately buy it if you have the opportunity. So what is important to understand right there is that if we take a look, for example, at a Figma right here. A Figma was also first. Well, let me actually take a different example right here. Let me use Roblox, my favorite example. Perfect. Let's see. So of course, these stocks, they don't just randomly open up at $64 a share right there when the IPO happens. And what an IPO is, we're going to dive into it. But what is important to understand right here is that they were privately traded before. So we continue higher, we are private for years right there. The stock, the company is private for years right there. Eventually we continue higher right there as well. And this is where, when it's a private stock, you can already capitalize on it. But what is important to understand, private stocks are hard to access. It's not going to be for everyone, if that makes sense. So for example, it's a lot of private conversations. You need to have a lot of connections, etc., to actually get into these investor rounds, seats, etc., etc. It's important to understand. But what this leads on to, because it just adds on to the next cycle is an IPO cycle. So what happens in an IPO cycle? In an IPO cycle right here, that is where we have the stock going from a private stock right here to then a public stock right here. This right here is where what we call the IPO. It's the initial public offering right there. So right here, we go to a public stock. Now in a public stock, usually there's a lot of hype. So for example, imagine if you put, let's say privately, a lot of investors, they might put 10 million into it right here privately. And it opens up right there and continues higher on a lot of hype right there. Of course, who wouldn't want to buy or sell some of the shares that they bought at $30 a share where they were 10 million to then sell it at 130? Of course, a lot of people are looking to share. A lot of people are also looking to buy right there on the hype. So what happens is a lot of time when it goes from private to now public, a lot of hype right here. This is where we move to the second cycle. This initial hype is not that interesting to me, but the drop off usually happens a lot. So for example, if you go over these stocks, you'll notice some are in the drop off as we speak. Some are climbing a little bit more out of the drop off right there, but they all look super similar right there. IPO right there, continue higher, a lot of hype, and we have the drop off right there. Significant drop off. So if we now go back to, for example, a Roblox, then what you'll notice is at this moment in time, the hype is gone. So what happens is now it just becomes real value. It's undervalued, arguably. This is where once you start seeing people are buying, again, based on the value of the company right here, you'll start noticing the order flow. So the fair value gaps right there, they start pushing price higher right there, and more and more and more. And eventually once that happens, the path to now reach a new all-time high again is very likely the all-time high that we made during the IPO, if that makes sense. So for example, Roblox is something I was a part of as well. And then right here, this is where it's going to be very interesting to look to buy these stocks. Think of, for example, right here, also an XPEF EV, sorry. Then right here, what we see is same thing, IPO, a lot of hype right there. We die down and now we slowly start to climb back higher right there. And that's very interesting. So that's the second cycle of an IPO where you can capitalize on it. Now the third cycle is a blue chip cycle. So what is a blue chip cycle? For example, eventually if the IPO is over and we start to continue higher, we get, for example, something like a Shopify, which is a very large stock, very large company, lots of market cap, and very volatile as well. That's important to understand. It's very volatile. So every time we now get these retracements right there, those are essentially new buying opportunities. See this as your new IPO right there, if that makes sense. So we get the drop off and we climb back higher. Now, that's something that happens across these lists. That's something that's happening, for example, on an Apple right here, right there as well. The drop off and we continue higher again. Now, what is important to understand? This ties in very nicely to the area of opportunity, because when we talk about area of opportunity, again, you can apply it to everything, arguably. So right here, if we take a look at something like Apple, we see the drop off right here. When we see the drop off, we have this weekly fair value area right there that is preventing us at that moment in time from continuing higher. So this, you could argue this one, you can also mark out that one if you want. That's the rejection high right there that we need to start running in order to now have a clear path to continue higher again. So the moment we start running that, then this right here is again going to be your area of opportunity right here. And when we start running the high right here and we reach the area of opportunity right here, this is now where it's super interesting to get involved. So this is, for example, very similar to what you see us talk about the dollar right here. When we zoom in, this is, for example, an area of opportunity. This, for example, is also an area of opportunity right there. Now, what is important to understand right here in these areas of opportunities, it's an area of opportunity. For example, if we start running this low, it could also be very well. And what we do a lot of times is we mark out the area of opportunity like this. So the first initial move that you have is essentially no resistance, right? Towards the next target. Now, this is where something is important to understand, because if we just take a look at this bearish fair value gap right here, this bearish fair value gap is order flow resistance, as we call it. So order flow resistance is where the bias is not clear. When we have order flow resistance, it's not clear. That means we're 50-50, essentially. Now, the moment we overtake that order flow resistance right there, we're not dealing with order flow resistance anymore. So all these highs afterwards, they become bump in the road resistance, essentially, right there. Bump in the road resistance, we don't really expect price to have a real difficult time. Of course, we could struggle a little bit, but not like order flow resistance where we might continue lower from it. So what is important is that when you have order flow resistance right here, you can often drag your area of opportunity quite far already, because all the resistance that we have in between right there is bump in the road resistance and not order flow resistance. So yes, we could expect a rejection like this, but then continue higher, rejection and continue higher again. So then, for example, reach a main target of, let's say, an intermediate term high at the highs right there, if that makes sense. That's very important to understand. So a very similar example right here. This is order flow resistance, that fair value gap right there. And then we also have, let me see, we also have the fair value area right there is also order flow resistance. So the moment that order flow resistance starts to fail right there, for example, this fair value gap right there is bump in the road resistance right there. These lows right here is also bump in the road resistance right there. This intermediate term low becomes the main target right there. So this, for example, is your main, your whole area of opportunity. That's why oftentimes you'll see me as well, just like I did on Apple, same thing on an ES, or let me actually use NASDAQ, a bit of a better example. If we start running or have a rejection high right there, and this is going to be your main area of opportunity right there towards the all-time highs. So for example, if we have a tiny 4-hour value gap right there, yes, could it disturb price? For sure. But it's not likely to push price significantly lower right there. For example, if we take a look, let's now use ES again. If we take a look at this example right here, we have this fair value area, rejection high. The moment we start running it right there, this is order flow resistance. We need to overtake that in order to get involved. Now, everything after right here is just bump in the road resistance. So the main area of opportunity is still right here towards the all-time high, if that makes sense. And that is very important to understand. Now, when we talk about these areas of opportunities, we also talk about two candle rejection, of course. So what we mentioned at the start, and you'll notice, I need you to understand, I'm not pulling these concepts just out of my ass, if that makes sense, right? So what is important to understand, they come from somewhere. They're not just randomly, all of a sudden, magically created. I started with an understanding of just fair value gaps. From fair value gaps, I got an understanding of what candle signs actually is. From candle signs, I got somewhat of an understanding of what two candle rejection, for example, actually is. And then from two candle rejection, you can understand when a PDA is actually being disrespected, respected, if that makes sense. So all these concepts, they just tie into together. They just tie in together. So that's why it's quite easy for me to explain, because they just go hand in hand with the next concept. Just an innovation cycle, if that makes sense. So right here, when we talk about an area of opportunity as well, we're also talking about this two candle rejection. So if we talk about this fair value gap and we talk about the trend that we mentioned earlier as well, how do you know we are disrespecting a PDA? We are disrespecting a PDA if two candle rejection is failing. It's important. So we need to understand when two candle rejection is failing. How do we know if two candle rejection is failing? In order to understand if two candle rejection is failing, we need to understand what two candle rejection is and when it's actually holding, so not failing. So what is important right here is, okay, when you have any PDA you can think of, and I just mean, of course, fair value area, swing points, and fair value gaps. Please don't start using this on any of these inverse fair value gaps, etc., etc. Don't do that. But right here, if we, for example, look at this swing high, if we look at this swing high right there, if we look at any fair value gap that you might have, that fair value gap right there, you'll always notice a certain pattern, or again, a very similar pattern. It's not always going to be the exact same, but you'll notice a very similar pattern. It takes two candles usually to create a rejection. So sometimes it's going to be the first candle, like we see with this swing high. And if it's the first candle, then what often happens, if two candle rejection is holding, the second candle should follow through right there to continue lower. I specifically emphasize on the word should, because should tells you what you should do when it doesn't happen. For example, if the first candle follows through, the second candle should continue lower right there. If the first candle is not a rejection right there, then the second candle can sweep the previous candle high right there in the worst case scenario to then create the rejection. If the first candle here is a rejection from this fair value gap, in order for this fair value gap to hold, the second candle should now ideally be a rejection. If that's not the case, what is happening? Two candle rejection is failing. So when we start running, because in the worst case scenario, we could still sweep this high to then continue lower. Very unlikely if the first candle is already a large rejection. But in the worst case scenario, that could happen, of course. That means we should run this previous candle high. What is this previous candle high on lower time frame? If you dive into, for example, the 15-minute time frame, how do we know if we are running a swing high? So running a rejection high. Well, what is running? Running a rejection high, running a swing point, running a swing high, running a swing low is the same thing as disrespecting a PDA. So when we sweep a swing low, when we, for example, let me see, can I find a nice example? These lows right here, right there. Here we're sweeping these swing lows. So what does it mean to sweep a swing low? It means we are respecting it. So those words are interchangeable, if that makes sense. They're the same thing. Sweeping is respecting, running is disrespecting. So right here, how do we know if we are disrespecting that swing high? Two candle rejection. Same thing. So first candle is not a rejection. Second candle can sweep the previous candle high right there. Okay, perfect. This turns into the rejection high, but more importantly, then the third candle should now follow through. The second candle is a rejection right there. Doesn't happen. The third candle is a continuation higher right there. So what does that tell us? That tells us two candle rejection is arguably failing at that moment in time. So here we can already continue higher. This is, by the way, if you were there at the Friday live stream as well, this is the exact same trade that I took. The exact same trade that I took right there and that I showed you. So that is very important to understand. And that is how you then, for example, now create this area of opportunity right there towards those highs right there. And then you know what it takes for that area of opportunity to someone to get activated right there through two candle rejection. And that's very important to understand. And the funny thing, all of this is based on fair value gaps. All of it. All of it. It's all based on one foundational concept, and that is fair value gaps. That's quite interesting, in my opinion. Okay, we also have daily bias and we also have psychology. That were the topics that we can dive into. When we talk about, well, actually, let me take a sip of water first. How is this? Does this make sense? Does it not make sense? Feel free to let me know in the chat right here. If it doesn't make sense, of course, feel free to let me know. We can dive into it as well. We can dive into it. No, Max, no. I'm saying the opposite. No. I need you to understand something. So, for example, if you take a nice Mars bar that is full of chocolate, and you don't understand what the ingredients are, and you start adding maybe a little bit of caramel, maybe a little extra chocolate, because you don't know what's in it, and you end up making the product just essentially worse. It's not like how it's meant to be, for example. The same with trading. These concepts right here. For example, order flow that we use already takes into account inversion fair value. So when I make fun of inversion fair value, I make fun of it as in, if you now use the concepts that I'm using right here, you don't need to use it because it's just an extra concept that you're now paying attention to that was already integrated in the trading plan itself, if that makes sense. But you don't need to pay attention to it. The same way, for example, how I make a little bit of fun of SMT. SMT is already, what did we do at the start of this live stream? I was focusing on, okay, which one is weaker right here and which one is stronger on these Forex majors to find the best one to buy, the best one to sell. So if you find the stronger one right here on EU, you've already integrated SMT. So you don't need to pay attention to it anymore, if that makes sense. So a lot of people, they start using these concepts and now start using these concepts that are already integrated. And that's like double chocolate on a Mars bar. It's like, what are you doing? That doesn't make any sense. If that makes sense, that's important. Mike is clipping. Let me know. I can check it afterwards as well. Thank you for letting me know. Thank you. Perfect, perfect. Synthetic indices is not really something I focus on personally. I've been struggling with my daily bias. Perfect. We're going to dive into daily bias as well. You did the perfect timing, my friend. Thank you, Gert. Thank you. Thank you very much. All right. Who's the MMT for? I would argue the MMT is for traders who want to take it to the next step and as efficiently as possible, ideally. That's who the MMT is for. So, for example, for a trader who is struggling a lot, they have the knowledge, and I think that's not necessarily a problem because there's so much knowledge out there. It's more so, how do you apply the knowledge in real time, for example? So how do you start applying the knowledge? How do you create such a structure where you apply the knowledge and you can consistently execute on it without a doubt, if that makes sense, over and over and over and over. So having a consistent process. And I think that's something that the MMT really, really helps with as well, taking you from that A to Z, essentially. I'll put a link right here as well. Anyway, I don't want to turn this into, it's tradingmt.com right there. Anyway, I don't want to turn this into a promo right here. So let's move on as well. Thank you. Let's see. We have a spectator. We have a spectator right here outside of the room. Making her appearance. Let's see. You have a lot of fans. Yeah. Okay, perfect. It's dulce. Dulce means sweet in Spanish. Very cute. Okay, perfect. So, Lyric, you were you joined at the perfect time because we're also going to dive into daily bias right now. When I talk about daily bias, I talk about something very specific, which I think is very important to understand. I talk about trading in between PDAs. A lot of people don't like my accent. Thank you, Giovanni. I appreciate that. We talk about trading in between PDAs. So let's dive into that. Okay. For example, this area of opportunity is not necessarily applicable to only all-time high protocols, right? You can use this on a lot of different instruments. So for example, a euro, US dollar, a GU right there, it doesn't really matter. But I need you to understand something, is that whenever we look to trade, whenever you look to have a clear daily bias, you're always trading in between PDAs. Always. It's the same thing. And that's essentially what it comes down to. So if you understand trading in between PDAs, you understand daily bias. That's important. So for example, the moment and the reason why this move lower happened right there, we reject from this bullish fair value gap right there. Okay. We trade back into this fair value gap, yes, but I want you to let go a little bit of what can we potentially continue lower from right there. So it's more important what is preventing us from continuing lower right there. So if we disrespect this PD rate, that fair value gap right there, by running this rejection low, this is where the daily bias now for a brief moment is very super clear, if that makes sense. And that is the areas you focus on. So if you, for example, start applying that on the chart right here, then on an EU, is the moment we start running this high, or the moment we start running those lows right there. So this, for example, is trading in between PDAs. And to be more specific, this is the next PDA right there. If we disrespect that PDA, it's going to be this one. If we disrespect this one, it's going to be that one. And you'll notice this happens over and over and over again. For example, the moment we start running these highs, that's when it's clear to target these next highs right there. When we start running those highs, it's clear to target these next highs right there. And it targets to the left. So a daily bias is all about essentially finding the moment we trade in between PDAs. And the first thing to then understand is, for example, the PDAs itself. So this is why it's also quite arguably, again, in my opinion, it's not ideal if you start adding PDAs, what we don't use, Because if you start adding these random PDAs, then what happens is you're going to add all these lines. So if you add all these lines right here, a lot of people think that the more you have, the more concepts you have, the more accuracy you're going to have. But I would flip that on its head. Why? Because the more concepts you have, the more you have reasons to do something, for example. So for example, what I think is important to understand, if you have many concepts, there's always a reason to do something. There's always a reason why we are rejecting. There's always a reason to do, at least to take action at that moment in time. So there's always a reason to do something. And how accurate is it truly, right? So what is important right there is that you want to got distracted right there. I saw something I want to touch on. What is important right there is that you want to have minimum concepts. So less concepts is going to increase your accuracy actually a lot more. So I see someone here mention as well. Yeah, so some people are taking these concepts right here. I dare to say, arguably, quote unquote, my concepts, at least the MMT concept right here, and they put them into an indicator and they try to sell it. If someone is trying to sell you an indicator, with all due respect, they don't want the best for you. With all due respect. How does that make sense, Ario? Because you also have an indicator in MMT. Listen, most indicators, they are just business models, of course, right? So the longer you stay subscribed to an indicator, the better it is for these people. So what is important to understand is that these indicators, they are not for your best interests. Mostly, they are just for the best interest of the people that are selling them. Now, of course, that usually happens in a business, but a business can also be aligned both ways. So for example, if I have the best interest for you and you make my business also better because I deliver a good service for you, then it's going to somewhat have an effect, right? A snowball effect, if that makes sense. So what is very important to understand is that the reason why we have indicators, for example, in the MMT, or well, specifically, we have one indicator, only one indicator, and that is this indicator, the probabilities indicator right there. It's the only indicator that we have. That's how you can objectively learn to understand what we're looking at that moment in time, at the arguments that we have. But if you, for example, have indicators to replace the understanding of a fair value gap, you understand, and everyone has access to these different indicators, it doesn't work, my friend. It doesn't work. I'm sorry to tell you, but it's just not going to work. So what I'm trying to tell you is an indicator should either help you in your learning curve, but it can't skip the learning curve. So a lot of people think that, okay, I can use an indicator to replace, to immediately get that profitability, right? That's not how indicators work. And indicators, they can help, well, speed up the learning curve, but they can't replace the learning curve. And that's very important to understand. So you can't have an indicator that is magically going to do all the work for you and is all of a sudden going to make you profitable. No, you still need to put in the work yourself. So that's very important to understand. That's why why I think if you're selling indicators, usually the people don't have the best intentions for you. In my opinion, of course, in my opinion. And let me know if that makes sense, the trading in between PDAs at daily buys. I think overall it's quite straightforward. We also have a video on daily buys as well recently, which might help you a lot as well. We also have psychology right here as a topic that we're going to dive into. What I think is important to understand about psychology is everything that I mentioned here. The technical. So a lot of people, so let me explain it like this. Remember how I just mentioned, when you have all these different concepts and all these different lines right there on your chart, you're going to be very overwhelmed. You're going to have all these random different things, all these concepts on your chart as well. So what is very important to understand is that your technicals should help your psychology, if that makes sense. So when you line up the technicals nicely, it's going to help, it's going to somewhat support, create a foundation base for your psychology to actually be easier to handle. And that's very important to understand. So if you have a very messy trading plan, your psychology is going to be messy. If you have a very structured trading plan where you know exactly what you're waiting for, etc., then your psychology is also going to be a lot easier to handle. So for example, when you have psychology problems, usually what that means is that you have symptoms for your technical side of the trading plan that's not completely there. For example, I think one of the best examples is you don't know when you're in trade, you don't necessarily know when to go break even. So you start stressing a little bit, maybe get a little bit anxious. That's a symptom. That's a symptom that you need a break even rule, if that makes sense. And that's very important. So when you have the break even rule, okay, then I follow the rule. It's a lot easier to now stick to your psychology. That's very important. So what it comes down to a lot is first having that very clear support base for your technical trading plan, and then your psychology building onto that. That's super important. So for example, why do we define an area of opportunity? Why do we define where I want to look to get involved? Can you imagine if, for example, I want to make money in trading essentially, and right here, I'm going to open this chart and I don't really know what I'm waiting for. And I'm like, well, I would like to make some money right here. I get a little bit stressed. I get a little bit anxious right here. I start having problems in my psychology. And that's usually a sign, well, I simply don't know what I'm waiting for right here. Okay, so if I know what I'm waiting for, it's going to be a lot easier to then handle that psychology. So the technicals and psychology often go hand in hand. So for example, with all due respect to Mark Douglas, late great Mark Douglas, rest in peace as well. Absolutely fantastic when it comes to psychology as well. But in my opinion, for example, what I think is very important to understand when I read a book, I'm not sure what the exact title is of the book, but I read the book, one of the first books when it comes to psychology and trading. And the book was a lot about you need to think like a casino, for example. So think on the long term, etc. And that's a great, great lesson when it comes to beginners. But when you then eventually try to scale your capital, thinking like a casino is not really going to get you anywhere, if that makes sense. So, and it's with all due respect, but then just trying to convince yourself, I need to think like a casino, I need to think like a casino, but the trading plan is bad. The whole setup before that is bad. It's not going to help you, if that makes sense. So that is very important to understand. So if you then have a clear first trading plan and then you build onto that, that's going to be, it's going to help you a lot. Now, what I think, if you struggle with psychology as well, record yourself, record the full process. The best psychology book that I've ever read regarding trading is I completely forgot the name. It's, what is it? What is the name? Suggest a few names, please, in the chat. Let me also search for it. Trading psychology book. I completely forgot the name. It's by, let me see, Jared, I believe. Jared Tendler. The Mental Game of Trading. That's the one. The Mental Game of Trading. It's the best psychology book I've ever read. The Mental Game of Trading. That's the one. So the Mental Game of Trading, what it essentially says is what it comes down to a lot as well. We apply the same things in the MMT a lot as well. When you start recording yourself and you start understanding what you're doing, for example, the moment before you get anxious, you might start tapping the table. And if I start tapping the table a lot right here, then eventually you know that you're in a certain cycle, because that tapping the table might lead to overtrading, might lead to revenge trading, etc. eventually. So it's often catching yourself in the act. And once you catch yourself in the act, then interrupting the cycle. And then you're making a new habit. So for example, if I'm trading right here and eventually the first part is I open the chart. There's the first part. The last part, so the other extreme, is where I'm now over trading, if that makes sense. In the middle, there's going to be a lot of signs and signals that my body and essentially my mind is telling me I'm currently in a cycle that's going to lead me to revenge trade, overtrade. So if I open the chart, I don't see a trade ID right here, and I now start scrolling, spending more time on the chart right here. I might start tapping my desk a lot. Again, it doesn't have to be a physical signal, but can also be I'm spending too much time on the chart right there. Usually what tends to happen is my mind starts to overthink right now. Okay, when my mind starts to overthink, then I'm in a cycle to eventually revenge trade. If I can now recognize that, signal, then I can interrupt it. And when you interrupt it, you create a new habit, if that makes sense. So then eventually it becomes a habit that your psychology is simply holding. Very good book, would highly recommend reading it as well. But what happens, what helps a lot in that as well is, for example, recording yourself. Because recording yourself, if you watch it back or even just write it down on a notebook next to you when you're trading, you're going to evidently see what has been happening, what have I been doing, how have I been doing, where did it go wrong right there, etc., etc. And also, for example, if I trade and I record my trade, it's very unlikely that I'm going to sit here and I'm going to tell myself, oh, right now I'm going to revenge trade because I'm angry. No. When there's a camera on you, you feel some kind of responsibility most of the time. So what happens right there is that you're going to take more serious action as well, even when no one is watching. That's very important. Let's see, he's mentioning running the 2 candle rejection high or low. Can you specify if he means running the first or second candle low? Depends. Depends on if the first or second candle is the rejection. Usually second candle, like SVY mentions. Let's see. But sometimes you will get a setup in a weak pair and get stopped out while the other expands. Yeah. Think about why it happens though. Think about why that happens. It's a beautiful thing to mention. So sometimes you will get a setup in the weak pair but get stopped out while the other one expands. Think about why you get the setup in the weak one. Because it's weak. So for example, right here, if we want to continue higher and we trade something like a weak pair, New Zealand dollar, US dollar right there, has been moving lower a lot. The reason why we even trade back into fair value gaps in the first place on a New Zealand dollar, US dollar, and for example, not an EU where we might create breakaway gaps, is because a New Zealand dollar, US dollar is weaker. So that is why it creates those retracements back into fair value gaps. So oftentimes when we create back into those fair value gaps, it's not always the best thing. If that makes sense. It's very interesting. Very interesting. Hello, Milky or Mickey. I got confused about relative equal highs and lows, which also got double top and bottom. I need some clarification from you. Let it go. Let it go. Let it go. Let it go. I would advise let it go. The reason why that is my advice is oftentimes people will see equal lows or equal highs. And for example, if you have all these equal lows right here, people will see those and they will think, they will get so obsessed with it. At least that's from my experience. Maybe I'm the only one. Could be, of course. But I used to get so obsessed with equal lows and equal highs that I think, oh, we need to trade back into that because this guy told me right here that that's where the liquidity is, etc. So we should trade back into it right there. It's just a swinging low right there. So I wouldn't obsess about we need to trade towards equal highs or equal lows, etc. Just try to let it go, if that makes sense. So really try to see, try to trade what you're seeing at that moment in time, objectively. Not because we have equal highs, we should trade towards it right there. No. If the market tells us we're going to reach for it, perfect. We're going to reach for it. And then it's a nice confluence that we have some liquidity right there. But other than that, I wouldn't get too obsessed with it, if that makes sense. I used to use commitment of traders reports. Yes, correct. Didn't really work for me personally. Well, it worked against me because the way it worked was I read commitment traders report. I read all this data, etc. Sometimes also macro data, etc. But what I noticed is that the macro data, etc., was telling me a certain thing, and the technical side was telling me the opposite thing. And then usually I decided I'm going to trust the macro data, and I'm not going to get involved. And at the end of the week, the technical analysis was just right. So if I had just followed my technical analysis, I would have actually got involved, etc., etc. If that makes sense. So that's for me personally. But if you make it work, perfect. Perfect. I have the 45 payouts in the last months. 45 payouts is, by the way, that's an incredible achievement. Very nice. Congratulations, Leonardo. Let's see, since 2 months, I blowed all my accounts and no payouts. I get too used to success, so my mind detaches from what I need to have to keep my trading good. Yeah. You get comfortable, my friend. You get comfortable. You get a little bit overconfident, maybe. You get comfortable. Usually what tends to happen is when people start also making a little bit of money, for example, they make money for the amount they are comfortable at. So if you're comfortable, there's not a real reason to do anything more, if that makes sense. You get a bit overconfident, you get a bit euphoric, feel like you're on the top of the world, etc. Doesn't push you anymore, if that makes sense. So sometimes blowing those accounts, of course, it's not ideal, but sometimes is the right kick up your ass to get going again, if that makes sense. So you already achieved 45 payouts. Next time 90. Why not? Go for it, my friend. Go for it. Keep yourself going right there. Keep yourself going. Very important. Push yourself. But that's incredible. It's incredible, Leonardo. So I wouldn't be too worried about that right there, because if you've already achieved 45 payouts, you're going to be back at it sooner rather than later. So just keep going at it. Very important. Keep doing your thing, my friend. In the FTMO account that I have right here, let me show you it. The risk that I usually have is around 0 to 5%. On the evaluations, I might risk a little bit higher. I might risk sometimes 1%, for example, maybe 1.5% also sometimes for the evaluation. For the live account, it's usually around 0.5%. So let me show you. 0 to 5%. Rarely, sometimes it will also be thingy. It will also be 1% right here. So all these trades, for example, is usually 1,000 profit, for example, right there. Jumps up from 99,900, 100,900 right there, if that makes sense. So it's constantly a jump right there of 1,000. 0 to 5% risk is what I usually tend to do. Perfect, Leonard. Keep me updated. We have a stock module coming actually. Why not futures? We have a stock module actually coming in MT, so that's why I'm working that out a little bit as well. It's on the way. It's on the way. I'm very excited for that. Probably towards end of the year, so think of November, December, something like that. All right, let's dive into some questions as well. Let me know right here. If you do have any questions in the chat as well, feel free to let me know. Let's see. Let's see. How do you confirm what a rejection candle is? To me, it's quite subjective. So I don't really have an objective. Let me quickly check something, by the way. I don't really have an objective way of saying it. Some people would argue it's when the wick is only in the fair value gap, so we reject below it, for example. I would argue a rejection candle, if you see it, there's no doubt it's a rejection candle. Very subjective way of saying it, arguably. But if there's a doubt, is it a rejection, is it not a rejection, then usually it's not a rejection and you can still expect the second candle to sweep, if that makes sense. So if the rejection is clear and obvious, that's a rejection. No idea, Gordon. No idea. Okay, let's see. Hello. No idea what that means. Nigerians under us will understand it. Let's see what your question is, my friend. Let me see. Oh, that's silly. I clicked it away. Let me see if I can still grab it. How silly. Let me see if I can stream back in my recording, if I can still see it. Yeah, there it is. Okay, so what did he mention? Or please, running swing high looks easy. Let me see. Let me see. I accidentally removed the question. There it is. Okay. All right, please. Running swing high looks easy, but it's not for me. Can we use institutional story 2 time frames below to confirm a run? Please, can you give a process to follow? Running and sweeping, I mention this quite often. What you really want to do is you want to study this. To do case studies around it, what I think is very important to understand. So yes, you can dive into the lower time frame, for example, right here with that swing high, and then dive into the 4-hour time frame to understand if we are running or sweeping it. But what I think is very important to understand right here is that on the 4-hour, the moment it looks like a sweep or a run right there, on the time frames above it, it might still look like a sweep right there. So combining the time frames is very crucial right there. Now, what I like to use is 2 stings. So for example, if we have this swing high and we have the first sting above it right there, we get a rejection from it. If we now sting back above it again, that to me is the run right there on liquidity to then continue higher again, if that makes sense. So for me, that's about really 2 stings and also about 2 candle rejection, combining the time frames, etc. If that makes sense. Now, my best advice in this case is also to mark out every swing high and every swing low that you have on your chart and see, when are we sweeping it? When are we running it? Combine the time frames right there. Start to understand it. For example, right here, we have 2 candle rejection, but also those 2 stings. So 1 sting right there, 2nd sting right there. 2 candle rejection failing, arguably. So that to me is already a run, if that makes sense. And then you'll really start to get a better understanding with the things we just mentioned as well. If that makes sense. Let me see. Question 1. What are the key signs that a bias is turning bearish? Question 2. Which primary bias is relevant for no re? Okay. Question 3. Okay. This is legal. 3 questions in one. We'll go for it. No worries, no worries. Okay. Question 1. What are the key signs that a bias is turning bearish? Discount rate is failing. So for example, right here, if we go over ES and we start looking at these prices right here to continue lower. If we start to disrespect this discount rate by running the rejection low, for example, right there, that's one discount rate failing. Now, that doesn't necessarily mean that we are completely bearish, because that could also be the case that we just have, for example, larger rejection to then continue lower again. But if that keeps happening right here, happens right here as well, happens right here as well, we keep running the lows, then we can assume, okay, we are bearish at that moment in time. We can continue lower towards these next targets, for example. So if, let's say, on ES, that might eventually happen, that we, or let's say on NASDAQ right here, a little bit of a better example, we start to disrespect this bullish daily fair value right there by running the rejection low. We start running these lows right there. And eventually, we will slowly turn bearish when the arguments also start to shift bearish, if that makes sense. That's important. That's important. Question 2. Which primary bias is relevant for the no re trading plan daily, weekly, monthly? Which primary bias? Not entirely sure what you mean with primary bias right there as well. So what I think is very important to understand is it doesn't necessarily change in that regard when it comes to no re trading plan. You're also still going to use a lot of area of opportunity when it comes to no re specifically right there. You just want to find the thing that has been going against you. So for example, if that's located on the monthly right there, perfectly fine. But then you can also still refine to the daily, to the 4-hour potentially right there to get a better understanding of what we are rejecting from and where that exact no resistance zone is, if that makes sense. So that's the way I would go about it in that scenario. Question 3. What is the current bias for crude oil and EU? For EU, parameters right here. So for example, we might have a no resistance zone from the area of opportunity right there, and also from this towards this. I was going to say, if I had to force an ID, if I really had to force an ID right here, I wouldn't be sure. No, if I had to force an ID, I would probably say right here, short term, maybe bullish right there to continue higher. But again, that's me forcing ID. It's only suspicion, right? So what is important is we just work with the parameters right there. That's all it is. And once we work with the parameters, we can get a clear understanding of what we're doing, etc., etc. So it's the same thing on EU, essentially, right there as well. For crude oil, it's not too clear to me. I'm not a big fan of this. Again, if I had to force a bias, I would say maybe bearish right here to continue lower as well, targeting these lows, etc. But I'm not a big fan of this, in all honesty. Don't like this price action. Let me know if that makes sense. Let's see. How do you confirm an order block or fair value areas worked? Because it's not like other PDAs like a swing high or fair value. That's true. It is the same thing though. So for example, for the daily time frame right here on the dollar, fair value area right there, it is the same thing, took in a rejection. So if we do start to continue higher, respect it right there, then it has worked, arguably, right? That makes sense. If that makes sense. Hello, Arya. How much time have you wasted on learning useless techniques before you actually found this one? What I wasted a lot of time on for myself is shiny object syndrome. A lot of time. So I wasted a lot on, for example, not improving a trading plan that I already had, and that just led me into quite a long cycle as well. If that makes sense. So there's South America. I think there's quite a lot of people from South America. Let me see. I went over this, by the way, so I'm not sure if the question was asked before it. Because we went over this as well during the live session right there. So order flow resistance is essentially the resistance that's directly right here. It's the order flow lag. It's directly against you. If it's not order flow lag right there, and everything else is bump and roll resistance, if that makes sense. From Argentina, very nice. Let's see. Hello Z. Okay, tell us, how do you plan to adapt when markets go into deeper retracements and all-time highs exhausted? For sure. So it's the same thing, right? Just turn it around. So for example, right here, if we do eventually get, I need you to understand, all-time high protocol is all-time high protocol at this moment in time because we're dealing with all-time highs. But it's the same way if we do get retracements, name it in a retracement protocol, it doesn't really matter because it's the same thing. So for example, right here, if we have this fair value gap, that fair value gap starts to fill right there, and we start targeting these lows, it's the same thing with trading in between these PDAs right there. So then it essentially comes down to the same thing. You start running that low right there, perfect. We can now target these lows. So then I'm going to be looking, instead of buys, I'm going to be looking at shorts right here in these areas, if that makes sense. So very similar what happened early this year. If we start running, for example, these lows, perfect. It's an area of opportunity to now target these lows, for example, right there. So the same thing happens, essentially. You just turn it around, if that makes sense. That's the way I'm going to approach it once we do see that we get bigger retracements. Hello, Louis. Can you show us how a token rejection can be disrespect on the lower time frame? How can it result in a trade? When should I stop looking at if it's a sweep? So we went over it a little bit as well. Here on the 4 hour, for example, if the area of opportunity is quite small and we have this rejection high right there, and I want to see token rejection failing on the lower time frame, I'm going to dive into the 50 minute to find the swing high, for example, right there. And then that's where I'm going to get into trades right there. So we went over a little bit earlier, if that makes sense. If that makes sense. Let me see. Is there currently any topic, before I dive into questions as well, is there currently any topic that you want me to go over as well? For example, for the remainder of this live session. Let's see. Here in the chat. Let me see. Feel free to mention anything. Yeah. Retracements, how deep? Okay. Fair value area. Okay. 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 But people are concerned about entries. Okay. Now we can dive into entries as well. Yeah. We can also dive into retracements a little bit. How deep? Fair value area. Fair value gaps, things that are necessary. Okay. We can dive into that. Let's do it. Okay. Okay, let's see. A lot of people are concerned about entries. So what I think is very important to understand, for example, is there's one important thing that comes for entries. So for example, you won't see me talk a whole lot about entries. Now, in the past, I've mentioned entries are not relevant and etc. Just get involved, and of course that needs a lot more nuance to it. So I need to clarify that a little bit more as well. But what I think is very important to understand is that first, before the entry, comes the area of opportunity. So the first thing you figure out, and always think of these foundational levels, right? So we have 5 foundational levels, essentially. You can also cut them down to 4 if you want to. Bias, 2 is narrative / context right there. Then number 3 is the entry right there. And then afterwards, we have risk management. So what is important right here to understand that these components are arguably more important than entry, or equally as important, but they come before the entry, if that makes sense. So you first need to have a clear bias, then you need to have a clear narrative / context area, and then you have the entry. So for example, the reason why I go over these areas of opportunity so much is because when I, for example, mark out this area of opportunity, I know where now I want to get involved. Because these areas of opportunities, the first thing I did, one of the first studies that I did, let me first break it down like that. One of the first studies that I did was, where do fair value gaps, where do order blocks, where do all these things hold? Why, for example, is it that here these fair value gaps struggle to continue higher, but why is it that these fair value gaps here have a very easy path to continue higher? Why is that? It's because of the area you're trading in. So that's what leads to eventually a context area, for example. So the entry needs to come in a context area, because the context area is where the entry is more likely to hold. So if, for example, you have a bias, but you skip the context area and you just go into an entry, it becomes very difficult, because then, well, what are you going to look at? What are you looking for, etc.? What is the area you're dealing with, etc.? So for example, when you have the area of opportunity right there, now I know I want to see an expansion entry in that area of opportunity right there. Or you might say, I want to see a fair value gap entry right there in that area of opportunity right there. And that's where you can now understand better, okay, what kind of entry am I looking at, etc., etc. And that is quite important to understand. If that makes sense regarding entries. If it doesn't, of course, feel free to also ask me, let me know, etc., etc. Let me see. I also mentioned also retracements. I want to dive into retracements. I think it's quite important. I think it's quite important to understand. What's the challenge with flow trading? It doesn't necessarily change the technicals though. Maybe you'll ask a bit more specific. Yeah, I think it's quite important to understand, because flow trading is the same thing. What I mean by that is, again, this 4 hour. So, okay, my mind is racing. I'm all over the place at this moment in time, but let me break it down from the start. What I think is important to understand is that flow trading, most people have the perception that flow trading is, I'm going to dive into the 15-minute, the 5-minute, the lower time frame right there, and that's where I'm going to do all my action. So just how I mentioned that entries, where you're going to take the entry, so the context area is super important, where you're then going to look for an entry. That's the same thing in flow trading. So for example, for flow trading, you still want to have an idea of what the higher time frame is doing right here. So if we disrespect this fair value gap right there to then continue higher, and we start running this rejection high to then target the ultimate high, this is still, no matter if you're a flow trader right here, still going to be an area of opportunity on the higher time frame. And that's important to still identify, because right now you can go into the 50 minutes right there. Okay, you can also find that same swing high, but as a flow trader, you can now also go, for example, into the 1 minute time frame to now see what are we looking at? What are the resistances here that we're dealing with? For example, we have that swing high. Okay, that swing high is what we're creating a rejection from right here. Can we overtake this fair value gap? And this, for example, is then an interesting entry as a flow trader right there. But the higher time frame remains the same. So where a lot of people go wrong with flow trading, and what is one of the most important aspects in flow trading, is time frames. Time frames. You need to have, because once you dive into the 1 minute time frame, you need to somewhat in the back of your mind still understand what was the 5 minute doing, what was the 15 minute doing. Okay, I'm in a 4 hour area of opportunity. Okay, perfect. This is the area of opportunity, lower time frame, etc., etc. Because if you just dive into the 1 minute time frame right here, of course, once in a while, this will work. But this worked in specific areas. Why doesn't it work here? Why doesn't this one work right there? Why does these fair value gaps right there? Why don't they hold right there? Specific areas. And those specific areas happen on different time frames. I've always mentioned that trading in itself is a skill. Trading is made up of multiple skills in itself as well. Psychology is a skill. Time frames is a whole skill in itself. How you go about time frames, how you take into account these different time frames, that's a skill in itself. That's very important to understand. So once you understand, okay, we are in a 4 hour time frame, higher time frame, area of opportunity, then you can dive into the lower time frame to find the area of opportunity, and that's how you create that whole cycle. So why is flow trading a lower time frame sometimes difficult for people is because you need to take all that into account. If I just trade the 4 hour right there, or only the higher time frame, I only have I only have 4 time frames to take into account. So it's a lot easier on your brain. Whereas if I go into a lower time frame, I need to take into account all these different time frames, then the lower time frame might feel like noise because it's so much to take into account, if that makes sense. That's important. Okay, and then I saw something about retracements. So retracements, how deep can we have retracements, etc., etc. Okay. How deep can we have retracements? General rule of thumb is retracements usually tend to come back into, for example, a discount rate right there to then continue higher again. So higher time discount rates. Or if you have, of course, a retracement like this, then it's a premium rate right there to then continue lower. But what is important, more important, and what I really want you to understand if there's one thing you can take away from this live stream, what I would love for you to take away is that it's not necessarily about the retracement. So, for example, right here on NASDAQ, we didn't retrace back into a weekly fair gap right there to then continue higher. On the monthly time frame right here earlier, we didn't retrace back into this monthly fair gap to then continue higher from it. Why not? Because the retracement ends as soon as there's nothing preventing us from continuing higher anymore. And that's the thing. If there's one thing you can take away from all this, then it's take away this lesson. If there's nothing preventing us from continuing higher, then we have all the reason to continue higher. The same way, if on EU, if there's nothing from preventing us from continuing lower, then we have all the reason to continue lower. So why is it so important to understand? There's multiple scenarios, multiple different scenarios of what price action can potentially do. Okay, so we could see a retracement back into a fair value gap right there, continue higher from it immediately, very instantly, very beautifully, like this, for example, where the retracement is over and we continue higher again. We could also have this fair value gap, for example, right here, and the retracement actually turns into a consolidation right there, and then only after the consolidation continues higher. Then the third option we have is that we have, let's say this fair value gap. That fair value gap right there, where we don't continue higher at all. So there's three different options. Now, what do all the options have in common? That you would have prevented this trade right there. You would have prevented the consolidation right here and only would have likely caught the winner. And you would have caught the winner right here as well. Where this consolidation, if you just focus on the retracement, might have turned into a loss, might have been a winner right here, and another loss right there. Now it's prevented, winner, and winner right there, and prevented before it. So what is important to understand right there, why does that happen? Because at all those scenarios, if we are going to continue higher, they all have in common one thing, and that is that the thing that is preventing us from continuing higher is disrespected. And the moment that happens, that's when the retracement is over. So for example, right here, the first time we sting into this fair value gap is right here, this moment. Now we still have something preventing us from continuing higher. So as long as this thing is preventing us from continuing higher, the retracement is arguably not over. So here we could still consolidate, could still retrace, to then only once we now we overtake the things preventing us from continuing higher, now we have a clear path to continue higher, if that makes sense. So this is why I think it's not necessarily about what can we continue higher from. If you want to be one step ahead of the market, it's more so about what is preventing us from continuing higher, what is preventing us from continuing lower, if that makes sense. The same way on EU, for example, at this moment in time, right here, if we dive into the daily time frame. So you'll notice a lot of retracements right here back into these fair value gaps, a lot of consolidation on the lower time frame. And then we have this daily fair value gap right there. So here, we could sit here, try to trade this 4-hour fair value gap, but as long as this thing is still there, the thing that is preventing us from continuing lower in this case, is not going to be great price action. So we want to run that to then continue lower, if that makes sense. That's important. Yeah, lower time frames is more noise. What is noise? How would you define noise? I'm trying to think of an analogy, but I can't really think of one. But what is noise? Noise is something usually you don't understand, in my opinion. I think, sorry to all the people that like metal music. I think it's quite noise, but I don't understand it. If, for example, you understand the magic behind metal and how it's made, etc., I can understand somewhere why it might speak to you. So to me, noise is something that doesn't make sense to you. It's a lot. Magic, for example, is something that is scientifically not explained. Very similar thing, in my opinion. So noise is something that doesn't make sense to you. So what I think is very important to understand when people most of the time say lower time frame is noise is because they don't know, they don't understand where to use the lower time frame, how to use the lower time frame, if that makes sense. So that is very important to understand, that if you understand where to use it, now it doesn't turn into noise, it turns into somewhat of a powerful thing that you can use on the lower time frame. So that's the way I oftentimes see it as well. Yeah, yeah. If that makes sense. Do you use kill zones in sessions for entries? Not really. No, not really. Quite funny that you say it. It's quite a good question as well, because I want to dive into that. So, depending on what time frames you enter, that depends on the sessions, the volatility you need. So if I use the 4 hour for my entries, I'm going to use a different type of volatility than I'm going to, for example, if I use 1 minute entries. The lower you go in time frames for your entry, the more of specific volatility you need. So for example, if I go into the 1 minute time frame for my entries, I would want kill zone volatility, so session volatility at London, AM session, PM session, for example, on the indices, because that's where the specific volatility is, where we can specifically follow through at that moment in time. Now, the higher time frame your entries, or on the higher time frame, the more daily volatility you're going to need. So for example, news, etc. Understand where the big news events are, etc., etc. Now, if I, for example, take a 15-minute entry, then kill zones, or even a 1 hour entry, then kill zones and sessions are not necessarily always that important, if that makes sense. If you simply use areas of opportunity right there to continue higher. And even overnight sessions, for example, where I also took a trade on NASDAQ right here, it can work out right there if you use 50-minute or even 5-minute entries right there, if that makes sense. That's the way I see it. I'm tryharding, definitely. Yeah, already 90 minutes. Yeah. I'm definitely tryharding, Steph. For sure. It's very funny. Yeah. Yeah, I think we're slowly approaching the end. Let me see. Feel free to mention something in the chat right here if you want me to go over anything. I feel like my brain, I'm slowly, you can even hear it. I'm slowly starting to struggle to speak as well, etc., etc. So, yeah. Slowly moving towards the end. Time frame alignment on token rejection is the same time frame. Start off with the same time frame. Do more focus on stocks. For sure, we can do that. Would you advise someone who is starting trading? Oh, brain is fried. To focus on one pair? Yes and no. Not necessarily. Not always. There's pros and cons. If you start off, it can be beneficial to focus on one instrument, either Forex or the Indices, for example, because I think there's quite a difference between that. Other than that, I would argue there's also some beauty in focusing on multiple once you get more into the trading. So getting familiar with the concepts, I would advise focus on maybe one instrument. If you eventually get into the trading, also, for example, focusing on one or two can really help you determine what the probability is, what the high probability scenario is, low probability, etc., etc. If that makes sense as well. Head and shoulders neckline explains. These two right here, and this is my neckline. This one right here. What did you see your first results in your trading years? Very early on. With my first trading plan, I saw results, but I didn't stick to it. With the first trading plan that I had, my first challenge, FTMO challenge, I got funded as well, but I didn't stick to it. It was just shiny object syndrome, and then eventually didn't have results, etc., etc. And then eventually I decided to stick to something. If you start off, I would just focus on one trade a day. If you start off, I would focus on, can you find one high probability trade a week? That's it. That's your main focus. Finding one high probability trade a week. That's the main focus. And then potentially, once you get a hang of it, you can then start focusing on, okay, can I find one high probability trade a day? Potentially. Because if you try to find one, if you don't really know what high probability is at the start, then it's difficult to say, can I focus on 1 or 2 trades a day, if that makes sense. Drink some water. Yeah, I will. Thank you. You could do that, Evelyn. Yeah. Yeah, I don't see why not, for sure. If you trade futures, that's all right. That's all right. All right, team. 1 hour and 30 minutes. A little bit longer. This is the end. This is the end right now. It's normal to blow up multiple accounts. Yes, as long as you learn from it. It's not normal if you keep blowing accounts forever. No, it's not normal. So you need to learn from it. Thank you everyone for being here. I'm going to keep you updated in Telegram, Discord, Instagram. Follow me anywhere, Telegram, Discord, Instagram. As long as you're somewhat in touch, then I'm going to keep you updated on times of the live session. We might move it a little bit earlier as well. We might keep it at the same time. We'll see. We'll see. What suits the most people, essentially. And that's what we're going to look at. So thank you everyone. Ooh, for the live session. Mucho gusto. I hope everyone has a great rest of your weekend. If it's already Monday for you, then sleep well as well. I'll take some rest. Thank you very much. Thank you, everyone. Thank you, thank you, thank you. And then I'll see everyone at the next one on Friday. We are back next week Friday with a recap. Sunday we do the forecast. Same thing as well. I'm not sure. My Telegram, you can find them a link in the description. Usually, I think. Make sure that if you find a Telegram that looks like me, make sure it is me. Because sometimes people get contacted by a fake Ario. It's not me. I probably won't contact you. I'm sorry, but I probably won't, if that makes sense. See you in MNT, Jonathan. Nice. Thank you. Thank you, Rasul. Thank you, Koda. Thank you very much. All right, everyone. Thank you, Marcus, for being here. Take care, everyone. See you at the next one. Take care. All right.